a recent article in Yahoo Finance. I know it made it over to Globe and Mail and other platforms as well, but it talked about RRIF withdrawals. So the minimum you need to take out of your RRIF, the rules around that need to change. And I completely agree with this article. So I want to kind of walk through the article a little bit, but also talk about why I think and where I think withdrawal rules and retirement income rules need to change in Canada to make it better for all of you watching this video as you enter into retirement. So the video highlights when you need to convert to a RRIF. So your RRSP needs to convert to the RRIF by 71, start taking money out. Now this changed in 2007 from 69 to 71, so it was bumped back once upon a time. Now the article talks about the issue of, okay, by 71 you have to start taking out a minimum amount, but does that force you, a retiree, to take money out of a registered account that you maybe don't need? It goes further to talk about, there's no maximum. So when you convert to a RRIF, a retirement income fund, then there's going to be a minimum and there's also no maximum. You can take out the whole thing if you needed to. Now, if your account is a locked-in account, a LIRA, a locked-in RSP, that will convert to a LIF, a life income fund. Now, a life income fund does have the same minimum. Now it has a maximum as well. So it's capped on the high end. So that's the difference between a RRIF and a LIF. So I think there needs to be conversations around both of these items going forward to make it more flexible for you, the Canadian retiree that's looking to kind of structure their retirement in the best way. Now the big conversation in this article talks about that we need to bump back the RRIF age. So you have to convert your RSP to RRIF at 71. The conversation is, should we be bumping that to 73, maybe 75 like the US? There's a lot of discussion around this. And all that means is you might be able to work longer without being required to take money out of your RRIF. Or maybe, you can retire earlier, but you're not being forced to pull money out of your RSP or RRIF at 71. You can delay it maybe till 75, which in theory sounds great, right? You're not forced to take income. Now, Jason Heath, the author of this article, financial planner here in Canada, made a good point, and it's a point I always make on this channel is, even if we bumped your RRIF minimum until 75, so let's say you retire at 65 and you don't have to touch your RSP until 75. That sounds great on the surface, but what happens is, A, you're going to take your CPP at 65 because you need some income between 65 and 70, and you're going to start living on probably a lot of TFSA, non-registered account, a lot of tax-free income. Outside of your CPP, maybe your OAS, you're drawing on a lot of tax-free income to keep that tax below. But fast forward to age 75, and now you've let that account compound for another 10 years, so it's probably worth double what it was at 65, and now you have to start drawing it out. And at 75, your life expectancy is only about 10 years or a little bit more. So it takes your account that you have to take out and squeezes it into a time frame that's maybe not doable to take it out in a tax efficient way. The second layer to this would be, okay, we've delayed your RSP to 75 to 85, 87, life expectancy, whatever you want to look at. We're going to draw out that RSP. We've been able to save those taxes from 65 to 75. The issue now, though, is that at 75 to 85, you got to draw out all this money, but oh yeah, you're 75. You can't do as much travel. You can't do as much stuff. You're not spending as much money. So the reality is all this money that you're able to take later on and defer that tax bills, you don't really need that income anymore. Maybe some of you do, but a lot of you won't. You needed that income from 65 to 75, but you were deferring it to 75. So when we talk about, delaying RRIF accounts until 75 or later in life, sure, the conversation's there. It's good to have. There's no harm in it as long as you don't take it as a set rule of, hey, I don't need to take my RRIF till 75, so I'm leaving it. I'm not touching that thing until I have to take it, and I'll take it at that time. You're going to run in a lot of cash flow issues, tax issues, and just planning issues. Again, I talk about the go-go, slow-go, no-go phase of retirement, and I need to stress this to all of you. If your retirement plan does not have this built in, you need to have your plan redone, have it adjusted, talk to your financial planner. I say this because I know for the last 20 years working with Canadian retirees, you will spend money from retirement date until typically about 73, 75. That's when spending starts to drop off, and it typically drops off the map quite quickly. So why not give yourself more? And there's kind of two parts to this. Give yourself more early because you can actually spend it, you can travel, you can do a lot more stuff. The second layer to that is like the slow go and the no go phase. You want to build a plan to say, hey, I can actually spend this money early and still have enough later on. Like there's the comfort in knowing, okay, if I spend 80,000 now, I'll still have my 50,000 later, which will support me okay. So instead of having a financial plan that says, okay, Joe, you get $63,000 a year, why not ramp that up to like 72,000, 75,000, then scale that slow, that middle frame, 75 to 85 typically, let's scale that back. And so if we talk about retirement rules in the article here that we're talking about, deferring your RRIF until 75, on paper in theory is a good thing. It's going to help some of you. Situations arise, it might allow you to, sell some rental properties. Maybe you retire at 65, you start drawing some of your RRIF, but then at 70 to 75, you have some rental properties that you're planning to sell, right? You can not be required to take any money out, sell your rental properties, trigger your taxable gains on that, and then start RRIF later. So there's a lot of planning and strategy there that could happen. So I'm all for delaying the RRIF number to 73, 75, whatever they want to do. I think the later the better. But I think we have to be careful, because if this happens and the headlines will praise, hey, you don't have to touch your retirement income, you can live tax-free for longer, that's really bad retirement planning. So I'm kind of trying to get ahead of the ball here and say, be aware of the headlines, the sales pitches, all of that. Remember, most financial planners, advisors, investment people in my industry, most of us get paid by assets under management, and most of us get paid through a mutual fund. That's just the way it is. So your bank, most financial institutions, your planner is probably getting paid 1% of your mutual fund. So you are invested in a mutual fund and they get paid, which means that the longer you keep your money with them and the more it grows, the more they get paid. So the concept of, hey, you don't have to touch your RSP now until 75. Let's just leave it there and let it do its thing. Take your CPP, take your OAS. If you need extra, take some TFSA money or whatever it is. Probably not a great plan for you. Maybe 1 in 100 of you, sure. The 1%, it might work out. The other 99%, that's really bad planning. You're going to end up paying more to CRA, putting less back in your pocket. Sure, retirement might still be there, might give you the income you want, but at the end of the day, you've worked so hard to build up what you've built up. You want to make sure you have good strategy as you go into retirement so that we're putting more money back in our pocket versus CRA, right? We all want to pay less tax. We all complain about how much tax we pay, but then we don't go through the process with a qualified financial planner to build a plan to save tens to hundreds of thousands, to some of our clients, millions of dollars of taxes. The last piece on the retirement changes that need to happen are the minimum amount. So every year from 71, or once you convert to a RRIF, there's a minimum amount that you have to take out of a RRIF. And again, if you're a LIF, a locked-in registered account, then there's going to be a minimum and a maximum. Now, they're talking about changing the minimum, scaling it back a little bit. And to me, again, if your plan has you taking money out of a RRIF, meaning that either you turned 71 or you converted it earlier, which a lot of our clients do, the minimum RRIF amount really shouldn't matter. I've never come across this situation where it really matters. If they bump the age to 75, that's going to help from that 71 to 75 range. But let's say right now you're 65 years old and you need to start taking some money out of your RRIF account, right? We want to start drawing and kind of leveling out some tax. Let's say you have a really large RRIF. You have $1 million in your RSP, meaning that if you open up a RRIF, you feel like, well, I have to move it over and I have to take out like 5%. It's just too much income. I don't need all that income out of them. Well, remember that you don't have to move all of your RSP to a RRIF. You can do a partial transfer. I'll give you this example. 65-year-old, $1 million RSP. You can set up a RRIF and move, let's say you only need 15,000 out of your RRIF every year. Just move 15,000 from your RSP to RRIF and then pull it out of the RRIF. Again, it qualifies for the pension income tax credit, income splitting. There's a lot of benefits to doing that. You don't have to move the whole thing. The minimum RRIF amount really, to me, doesn't play a factor at all. I know there's been other planners that talk about it in this article and other articles. I don't see it. I think if you bump the age, that does enough for that little gap from 71 to 75, but typically we're never pulling out the minimum RRIF amount anyway, so what's the big deal? I think the one case I can come up with, and it just came up in the office here the other day, is a client converted to a RRIF, they're taking money out, and they ended up going back to work. And we set their RRIF payment to annual in December just to give some flexibility. They're probably not going to need it this year, and they probably don't want it this year because they've actually had a pretty good income with their business. But what we can do is just roll the RRIF back into the RRSP. So that's kind of the way around it. So again, I don't know if it's required to lower the amount that you have to take out of the RRIF, but that's a conversation as well. So the rules they're coming out with aren't necessarily for you, and they're not necessarily beneficial for you. So as rules change, as headlines come out, make sure you consult with your financial planner. Make sure you understand, like, does this affect me, or does my plan just keep rolling forward? And for most of you, it won't affect you at all. For some of you, it will create more leverage, more flexibility, and a better tax planning strategy as you enter into retirement.